George of the jungle, strong as he can be.
Okay, so let's get into part 2 of our Where Does Mortgage Money Come From video. Thanks for joining me today. This is George Anderson and you are in thecreditjungle.com. And we had a previous video and I just want to break this into 2 parts just because, I mean, my attention span's only good for a few minutes anyway, so I don't expect anyone else to exceed that. But in the previous video we talked about where the money comes into to come into Fannie Mae, Freddie Mac, and Ginnie Mae to be able to do that. But then how do you as a consumer, how do you access that money? So the question is, I mean, doesn't Fannie Mae like the Apple Store? I mean, if you want an iPhone, you can go to the Apple Store and you can buy your phone from the Apple Store, right? Can't you just go and knock on the door of Freddie Mac and say, can I please apply for a loan? The answer is no. They do not have a consumer side to their business at all. This is strictly a business-to-business entity. And when they purchase a loan, I mean, they are buying commitments. Okay, and these commitments, you know, are millions and billions of dollars worth at a time that they're dealing with big blocks of money. So there's some in-between steps here from where the loan originates and how it gets delivered. And you know, I'm just not going to even go into that, but there's some consolidators and there's some servicers and there are some sub-servicers that all play a role in between here. But you as a consumer, there's 3 channels or platforms that you can access mortgage money, and there's 3 options, and that's 3 options only. So you can go to a federally chartered bank or credit union, you can go to a mortgage banker, or you can go to a mortgage broker. And let me just explain just the few of the differences in between each one of these. So a federally chartered bank or credit union, most of the time, if you go in there, you've got your tellers and everything else, and then there is a tax ID number, there's a business entity that is the banking side of things. But there could be a desk right in the lobby and it shares the same building, and over there it says the mortgage loan division or something. In most cases, that's actually a separate entity with a different tax ID number operating underneath the umbrella of the federally chartered bank. So now sometimes it is, sometimes it isn't, but the mortgage entity itself, again, they are not using banking money per se. So somebody will go to the bank and say, well, I want to go and get the loan at my bank because they'll keep my loan. They're going to service my loan. Well, hopefully there's enough people listening here to know that that really doesn't happen. Okay, there are some exceptions, okay, where that happens, but for the most part, your bank is selling the loan to Fannie Mae and Freddie Mac, and you're going to have a different servicer in here. And if you're making your payments to the bank, okay, the money still came from here. All that the bank did was retain the servicing. Okay, they retained the rights to service that loan, but they originated that loan, got it delivered to Fannie Mae and Freddie Mac. Fannie Mae then purchased that loan from the bank, and the bank retained the servicing. So you make a payment to the bank takes a little scrape off of your payment and then sends in the principal and interest portion to one of these 3 entities, who in turn, Fannie Mae and Freddie Mac, they take a scrape and then they pay a rate of return to the ultimate investor. So just imagine this, if you've got your mutual fund in here, do you want to be dealing with trying to collect payments from 1,000 homeowners and dealing with foreclosures and late payments and end of year escrow agreement reconciliations and all of that stuff? No. That's where you have the servicing component here, that they deal with that and they get paid to do that. So let's just say maybe your interest rate, you're paying 4% here to the bank. The servicer is going to receive a scrape maybe of, let's just make it easy, let's just say 1/4%, then there's 1/4% here, where the ultimate investor here is going to be earning 3.5. But in exchange for that, all they're doing is just getting a pure rate of return on that money, along with some capital appreciation or depreciation based on the fluctuation of the price of the bond or the mortgage-backed security that you purchased. But anyway, so a mortgage banker, okay, is a mortgage company, that does not have a depository side associated with it. In other words, instead of having the bank where you've got your teller here and the mortgage division over here, a mortgage banker doesn't have the depository function going on there. There's not a banking side to it, it's just the mortgage banking. So it's a mortgage entity. So in other words, they will fund the loan in their name, just like the bank would fund the loan and close the loan in their name. Okay, but then ultimately that servicing in between here might be picked up by somebody else, or they could service the loan. Both of these entities have the capacity to service a loan, but most of the time they're going to have a sub-servicing agreement, or they're going to completely sell that servicing so that they can get their money paid back from here and do that. So this ends up being a fee income rather than residual income for the bank. In other words, it's not something that they're earning a yield on interest on a monthly basis. That's who these people are. So anyway, and then the third one here is a mortgage broker. So a mortgage broker would have relationships with some of these entities that they can function here in between as a wholesale mortgage lender. So the mortgage broker doesn't underwrite the loan, they don't close the loan, they don't fund the loan in their name, but they can go and decide, well, your loan might fit better with this bank or with this mortgage banking company here, and then they're approved to be able to have these places underwrite, fund, and close the loans on their behalf, and then they pay them a fee for that. So now, in 31 years that I've been in the mortgage business, I spent 15 of those years with my own mortgage brokerage, and then I had the other 16 years, about 2 years as a mortgage banking, a correspondent lender with myself and a couple partners, and then also just as a mortgage banker as kind of what you would just call an office, an enterprise branch, if you will. Kind of like a farmer's insurance agent that has a bunch of different insurance products, but it says farmer's insurance on the outside, but he's an independent agent. So I'm in a mortgage banking capacity here, but I also have the ability to broker loans that my bank may or may not have an appetite for. So I have access to both. It's worked out well for me. But anyway, the difference between, so I've had some people that have told me, and I had a story a few years ago, where I had a good friend of mine that he had gone to his bank because he had a pretty good business, lots of deposits, lots of cash flow going through there, and he went to his own bank to be able to get a mortgage loan for his house. And we were just talking, and he just said, oh, I'm getting a loan for this house, and I know you're in the business, George, can you just tell me, where would you be as far as rates and fees and stuff like that? And I told him where I would be, and he said, wow, well, that's pretty good. And so this is interesting. So I closed the loan, and this was actually back in the days when I was a broker, so this was probably about 15 years ago. I closed the loan, and one of the banks that I could sell the loan to was his bank. But I gave him a better deal than what his bank was giving him, okay? So the reason is because I was performing some of the front-end functions of the loan, originating it and processing it and everything else that the bank didn't have to do. And sometimes you can even do that as a mortgage banker, and I've done that as well too, where I'll originate the loan as a mortgage banker and then sell it to this bank, who then sells the servicing and then comes back to Fannie Mae that way. But the difference between these three entities here is that these first two here, they have what is called liability, okay? So in other words, if this loan cannot be purchased, in other words, Fannie Mae gets it. So in other words, we funded and closed the loan, and Fannie Mae finds out, oops, you guys made a mistake, okay? They don't buy that loan, okay? And that loan ends up being, a pretty significant amount. If it's a $300,000 loan, it might get parked on what's called a warehouse line for a long time. There's some remedies and there's some things you can do. You can, there's options to be able to fix that. But on the broker side here, there's not as much liability. So typically, a mortgage banker here, where we have the liability on it, and we understand, that we have the ability to maybe fix something if we need to. I found a lot more flexibility with my underwriting guidelines, because in this capacity here as a banker, I had a bunch of different banks, and each one had their own different underwriters here. Whereas here, I've got a team of a half a dozen underwriters that I've developed a relationship with for a long period of time, and they know that we're employees of the same company. And so we're literally on the same team. We're not competing against each other. but our idea and our goal is to be able to provide excellent service to our customers and make sure that we're doing loans that can be sold to one of these three entities. So hopefully that makes some sense, but everybody's going to sell their loan, so don't go under the auspices that, well, I'm going to go here because I think they're going to keep my loan, and it's highly unlikely that they would do that. You've got just as good of a chance here originating a loan with a mortgage banker that they will keep your loan as you do with a bank. Here, by definition, it's brokered out, and it does not happen that way. So hopefully that helps you understand a little bit of this cash flow and how all of this stuff all comes together, and maybe helps you make a decision on which type of a person you should work with. But I think it really boils down to the loan officer themselves and what's their experience and how comfortable are they with those guidelines, and then do they have a good staff to be able to support them and get that loan through the processing and the underwriting phase to ultimately get you to the finish line and close your loan. Because once it's closed, all the stuff that happens after this, nobody cares as long as you make your payment. So thanks for coming into the creditjungle.com today. This is George Anderson. Push button, get mortgage professional, and I hope to talk to you soon. Have a great day.